go live on it. That goes live on all social media.
And we are live. Let's go.
It's on one of them, and then it records it, and you can send it out on all different platforms. Yes, because we have a lot of platforms.
And we are live today, guys. Every week, every Tuesday at 4 p.m., we're going to bring you an expert in real estate. It could be a home inspector, attorney, title guy, or maybe a mortgage guy. So who do I bring you today other than the guy when it comes to the numbers, Peter Karlin. Pete, what are we discussing today?
Today, we will be discussing, first of all, thank you, John. I appreciate it.
Thank you.
Thank you for having me. We're going to be discussing closing costs. We're going to be if we have time, I think we will. The buy down, temporary buy down.
Temporary
2-1 buy down, 3-2-1 buy down, 1-1 buy down, 1-0 buy down. Yeah, temporary buy down. Very hot today.
And I mean, that's huge, right? Because in today's market, the buyers, they shop around, right? Because of the raise, their budget gets really squeezed out. So they really want to make sure that they pay as lead closing cost, right, as possible.
Yeah.
And then possibly, because the rates now, what is like 6%, 7%?
I have hit the fours. I got a 4. I'm in the 4s, ladies and gentlemen. FHA.
You guys want
4.875.
4%. That's what we're going to discuss today. So, Pete, the floor is yours.
Thank you, sir. Appreciate you.
Thank you, bro.
My pleasure. My pleasure. Okay. All right. So, just to recap, I mean, I'm not going to recap. Actually, last week, I was here last week and we spoke about, let me just get this up. Give me a second. We spoke about the pre-approval process, right? So I'm not gonna go
Too deep into it.
I'm not going to go, but how important it is for the pre-approval process and how important it is to pre-approve somebody before you're taking somebody out, right? It's very important to do that. And obviously you know that because you don't want to waste your time. You don't want to waste the buyer's time, the listing agent's time, the seller's time, right? Important thing. Okay. So let's talk about closing costs, right? Everybody has, how much are my closing costs? Very important factor, right? The two things that you have is the down payment and the closing costs. So I have a calculator. It's a spreadsheet that goes through the approximate closing cost. It's a quick way to. By the way, if people have questions, should they hit us up with questions?
Absolutely. So as we go, guys, I know this is live on Facebook and Instagram. Any questions you have, if you're watching this live, just drop it down in the comments below and we'll make sure we'll get you the answers. And if you're watching the recording, give us a comments as well, because we'll be going back and giving you answers as well. So let those questions fly.
Thank you, John.
Thank you, Pete.
Okay, so now I should be conscious of questions coming.
Yeah.
Okay.
I'll check it. Once we do it.
All right, very good. All right, so let's go into, right, let's go back to a scenario. Actually, okay, so we have this scenario. This is from the pre-approval process that we spoke about last week. And this is a calculator. This is a calculator that you guys who I spoke to last week, you've seen it. Basically, right, just to go through quickly, our purchase price and everything in dark green is a user entered field. So you put in the user entered information and it calculates everything thereafter.
Now, so I see some questions, people asking if they want to get access to the calculator.
Yes, I will. Hey, Monica, good to have you with us, dear. Yes, if people want access to this calculator, let me know. I will send it to you. You can have it. You can play with it.
Just if you want it, drop your Instagram below in the comments, and you got my Instagram. So just send me a DM on Insta and say, I want Peter's calculator. And that's it. And we'll make sure we'll send it to you.
Okay.
Keep going.
Monica, by the way, I have an answer for you on the FHA 2 or 3K, and I'll get back to you on that. Okay, so the dark green fields. Dark green fields are the user-entered fields. Real fast, right? We'll go. This is what this is showing. This spreadsheet is showing is the purchase price, the down payment, the monthly estimated monthly PITI, principal, interest, taxes, and insurance, and also how much you need to income. It shows you the debt to income ratio, right? Debt to income ratio, very important to figure out whether a loan's going to work or not, right? What's important when you want to know if a loan's going to work is the debt to income ratio, is the credit, is the assets, right? You want to make sure people have enough money to make the loan work. So in this case scenario, it's a $760,000 purchase, 20% down. That's $152,000. Loan amount is $608,000. Here's the income for our borrowers, $127,000 annually. Break it down by month, $10,617 on the month. And then we had some debt coming off the credit report. And then our interest rate, when I did it at this time, was 6.75 on a 30-year fix. And then at the bottom here was our principal, our mortgage payment, right? So the mortgage payment also showed the property tax, the homeowner's insurance, and our mortgage payment for this particular buyer was $4,500. $4,500 divided by 10,617 gave us our front end ratio. And we distinguish between a front end ratio and a back end ratio. Front end being what we call the housing ratio, which is just your housing, which are, the difference between your housing payment and your income. And then the back end ratio, we add in other monthly debt that you might have on your credit report or loans, student loans, or car payments, stuff like that. So that's the back end. It's the housing payment plus the credit debt. Take that together and divide that by your income. That's how we get.
Now, real question, right? On the debt, if someone has a car loan of $35,000 and the monthly is $5,000, and they have a credit card of $15,000 and the minimum payment is $250, do you take the whole balance?
No.
Or do you take just the monthly minimum payment?
It's a good question. And what we're taking is the minimum monthly payment. The minimum monthly payment. And as I said, again, I'm not going to get into it, but last week, how I said we could try to, if we needed to get the debt to income ratio down, like for instance, on an installment loan, on a car loan, or something like that, specifically a car or other type of loan, if you take it down to 10 payments or less, then you could negate that minimum monthly debt in the monthly liability. Okay, so moving on. Okay. This is an example of wow, this is great. So this is the spreadsheet that I just showed you before, but this is a different scenario, okay? This is an $850,000 purchase, 20% down, 170 is the down payment, 170,000. Your loan amount is 680. By the way, I'm going to get to your comments momentarily. I'm going to go through this screen, and then we're going to look at the question. So, in this case, I put 150,000 as this gentleman's income. This particular loan, by the way, it's a 7.625 interest rate that I put down here. This loan is a no income check loan, or I should say it is an income check, but it's using the bank statements to qualify the buyer.
Sweet.
Which is really cool, right? So we don't look at tax returns, you don't look at W-2s, you don't look at income traditionally, right? But when you go with a non-traditional income product, we call it non-QM, non-qualified mortgage, it comes with a higher interest rate. That's just the way it is, right?
Special loan, you get a
special loan, you get a bump up in the rate. I mean, that's how it goes. So in this particular case, so using his bank statements, He's at about 12,500 on a monthly income. Now down here again at the bottom of the spreadsheet, we show the mortgage payment, 7.625 on a 30-year fix. And his principal and interest is 4,800. Of course, principal and interest doesn't change for the life of the loan. But what can change, obviously, is property tax and homeowners insurance, because things change in the world, right? So property tax on this particular home was $6,200, $6,239. Homeowners insurance, we're guesstimating at about $1,300. I always like to go a little higher so I can come down, be a little conservative, so you don't get hurt in the end, or get caught, because your ratios don't work. $5,400, $5,441 is his monthly payment. $5,441 divided by his 12,500. Our ratios are under 45. We like that. It's a 43.5. Okay, so that's a good thing. Okay.
So just for those of you watching, I know, Pete, we did the training on the calculator and the DTI last week.
Mm-hmm.
I know some people haven't seen it. If you guys would like Pete to come back and do the calculation and do the DTI, just put in the comments.
Okay.
And we'll make sure that Pete's going to come
DTI,
back again.
obviously, debt versus DTI, debt to income ratio, extremely important stuff. Extremely important stuff. Okay, so closing cost worksheet. Okay, let me show you. There are two sections to closing costs, right? There are two sections. We have the prepaids and the escrows, and then we have like the main costs. Why that's broken up, I'm not exactly sure.
On the prepay and the taxes and the escrow, that's like money in the bank, which you're going to use towards your payments, right? The fees, that's kind of like you paid it out, title, insurance,
Good point.
Origination fees, that's money out, they got, right?
Correct.
Using it going forward.
Well, but the appraisal is money out too.
I see.
But but they call it a prepaid because you're paying for the appraisal before you get to the closing table.
Okay.
Right? And typically you will pay for the homeowner's insurance before you get to the closing table. Now, a lot of people say to me, why am I paying for homeowner's insurance before I even have the house? It's a good question, but we want you to have insurance in place on the day. First of all, you need a paid in full receipt, but you want to have insurance in place the day that you're closing. God forbid something happens when you're at the closing table getting the property transferred over to you, and something happens to the house.
I mean, it happens.
I mean,
I've
never had it happen.
Yeah, but it does happen.
I'm sure it's happened.
It happens.
Could you imagine? I mean, just imagine.
Every moment you're like, oh my God, honey,
I mean,
let's go walk the house.
a lapse in insurance, and and unfortunately, I've also had it where the insurance company didn't know the closing was taking place, and they didn't, they didn't bind the policy on that day, and thankfully nothing happened to the house, but there was a lapse. That's not a good thing.
Well, I just said we had one scenario recently with one of the buyers, right? Where she was like, I want to prepay the insurance because what happens if I don't close on the house? I'm going to lose the money?
No, right. So that's what I was getting to. So when you pay for the insurance, you will get that. If you don't close on the house, you get the money back. It's the same thing with car insurance, right? If you prepay for 6 months of car insurance and you decide to change companies, you're going to get that money. You're going to get a prorated portion of the money back, right?
Whatever you didn't use.
And it's the same thing if you switch homeowners insurance companies during the process, you're going to get that money back as well, right? You're going to get that money back as well. Insurance companies, to my knowledge, they can't hold money for for the time that they didn't, right, that they didn't use. Okay, so let's go through. I don't know if these guys on the camera can see this. I don't know if we want to make it closer.
Let us know, guys. Can you see well the screen what P is showing? If you can, I can bring it closer.
Yeah, I think bring it closer, and maybe next time what I'll do is as well we can have it on their screen,
100%,
right? So they can see it on their screen, and then it's just a little.
We can share it.
Yeah. That's the way we should do it. That's the way we should.
Hey,
do it.
we
All right,
all,
we're
we
learning,
always
we're
making
learning.
it better, guys. We
Trying
got
to
we
make
got
it
we got
better.
a better angle on Pete today. That was important, you know.
What's that?
Just wants the airtime.
All right, so purchase price $850,000, right? So this basically is showing you this scenario, right? And the mortgage payment here is showing you this scenario. So this is just brought over here, but the additional stuff is the closing costs, and we're going to get into that, right? So 7.625 now. In order to get the only thing different here, right? We have the purchase price, the LTV, which is loan to value, right? Loan to value is taking the loan amount, dividing it by the purchase price, and you get a loan to value. It's basically the opposite of what you're putting down. So if you're putting down 20%, 100 minus 20 is 80. That's your loan to value, right? If your loan to value, if I say your loan to value 70 LTV, how much are you putting down? 70 minus 100 is 30.
So
Very
we're learning some bank
lingo. You're learning banker lingo.
LTV.
LTV, right? But it's important to know, right? Okay, so here's all this stuff. We went through it before. The only thing different is here I show you points. Points. What's a point? A point is 1% of the loan amount. 1 point is 1% of the loan amount. So if I say we're charging 2 points, we're charging 2% of the loan amount, which is part of it. It could be an origination point or a discount point. Origination or discount. What's the difference? Origination point is typically a point that the bank charges for their fee. Either the broker or the bank charges for their fee. A discount point is usually buying down the rate. It's a discount to the rate. Right? So you're buying down the rate. So you might say, well, I want better than a 7.625. Okay, great. You can pay an extra point or 2 or 3 to buy down the rate. Okay, well, what are my buy downs? And then we look at a mortgage person, we'll look at our chart, and we'll tell the buyer what the buy down is.
Can I buy down, like how many points can a buyer
Good question.
buy down? Can you go down all the way to 0%?
No, you can't.
No,
you can't. So it's dictated. That is dictated by the rate chart, number one, but also by the rules of the government, right? We have something called HPML, high priced mortgage loan. High price. I should know that. Sorry, guys.
High price mortgage loan.
High price mortgage loan. High price mortgage loan. High price mortgage loan. So there's a restriction. Typically, it's 3% on a government agency loan. At 3, you can't charge more than 3% of fees and stuff like that. So there is a cap. Yes, there is a cap. You can't get crazy on the buy downs. Okay. So I told you about points. Now sometimes points have a right? The origination points and the discount points are combined into one as well. But you can ask your loan originator about that. So let's go through the costs. What do you have? You have points, right? In this case, it's 2 points origination to get the rate and for the bank fee, both combined. 2 points, 2% of the loan amount, 2% of 680,000 is 13,600. Then you have different banks have different fees for processing and underwriting. I've heard as much as 2,500 for one. I've heard 850. In this particular example, for this particular lender, it's about 1,055. It really shouldn't be more than, it shouldn't be more than 2,200 and probably not less than 850 or something like that. That's an underwriting processing fee. Then you have a bank attorney. So you, the borrower, pay for the bank's attorney to represent the bank at the closing, right? In New York City, New York State, really, and in many states, well, really, we have attorneys that represent the buyers. And of course, you have an attorney that represents the seller. In many states, they don't. They just use the title company. But always in New York, we have bank attorneys, right? We have bank attorneys, and the buyer has to pay for that bank attorney's
Who
fee.
does the bank attorney represent, the bank or the buyer?
Who does who?
The bank attorney represents.
Oh, the bank
buyer,
attorney is representing the bank.
But the buyer's paying for it.
That's right, but the buyer's paying for it.
Sweet.
Yes, sorry about that, but that's the way.
Now,
it
also,
is.
I know the cost on it. It's, what is it, $1,000, $1,500? I know sometimes you could use your attorney, your buyer's attorney, to also be the bank attorney
Right.
and give you a discounted rate.
That is correct. So I frequently, because it's allowable by the law, will use the same, whoever the buyer's attorney. A lot of the buyers that I work with, the attorney is the same attorney, and I know them and I've worked with them, and because the realtors that I work with use the same. They recommend a particular attorney to their buyer, and that buyer's attorney I've known because I've done a lot of work with them. So, and I like them. So I also I allow them, I select them to be the bank attorney as well. So it makes it easy as well at the closing table. They know the
100%.
whole deal. It makes it
For
simple.
communication, for everything.
Communication, and yes, frequently there's a discount that's given to the borrower as well because we're using both attorneys. And of course, it's disclosed, so it is legal. We would not do anything that was not allowable. So, good question. Okay, then you have a credit reporting fee. That could be anywhere, and it depends on how many times we run credit, because sometimes we could run credit a few times. Sometimes I help people fix credit during the process. So, when I fix it and I have to do certain things and then I have to run credit, more than once, the credit reporting fee can be more. But typically it's somewhere around $50, $60 to run credit. Then you have a flood determination zone fee. Flood determination zone fee, that's a fee that determines whether your house is in a flood zone, right? That's like $10. And then now title fees. Title. So title is very important, right? What's title about? Title is really protecting you, the buyer, and the bank, so that when you, the buyer, take over that house, you have it free and clear of any issues, financial issues. And also perhaps open permits or violations, right? But we want to make sure that there's no open mortgages, that there was no other person other than the seller who has rights to the house, right? So when the title company basically insures the transaction, right? They're insuring the transaction so that no one can come back to you where there's not an issue, that you're basically getting the house free and clear of any issues, any liens, any judgments, open permits, violations, all that kind of stuff. So you have to pay the title company to do that. Typically, you, the borrower, have the right to actually pick a title company of your own choice, but frequently, most of the time, because you don't know title and you don't know title companies, it's the borrower's attorney that selects the title company. And they're pretty much, to be honest, the fees are very negligible and very,
right? It's almost all the same.
it's almost pretty flat all across the board. Which brings me to the next thing. So how do I figure out title fees? I have an online calculator that I go, it's a website that I like of a title company, and I put in the information. I could show you guys now, but I put in the information, one family purchase in Queens, New York, and here's the purchase price, and here's the loan amount, and here it's going to be one borrower or two borrowers, and it tells me what the title fees are, and it tells me what the mortgage tax is. Mortgage tax in New York City is about 1.8% of the loan amount. It's about 1.8% of the loan amount. So it tells me all these numbers here: title insurance, recording fee, because you got to record the title, right, with the city or with the city agency or the county. So you have to record it. You have title searches, right? These searches that I told you about, you got to make sure that free and clear, that there's no liens or any judgments or anything like that. So you have to do searches.
That includes the municipal search for the water, taxes,
all that stuff.
The whole
Yep,
thing.
yep. Now, interestingly enough, where I work, they don't require, and many banks, well, I don't want to say many, but there are banks out there that don't require these searches.
However, it's something you as a buyer, you should always know.
I don't know if you guys heard that, but I'm going to say it again. So what John just said is, as a buyer, even though the bank doesn't require those searches, you want to do them because you want to know municipal searches, right? These are things that show you open permits, open violations, issues like that. Even though it's interestingly enough, the bank doesn't need to see it. And for what reason, I don't know.
Your bank.
My bank.
Don't try to go to the city. Don't try to go to the big banks.
But here's the thing: you want to know, and your attorney wants to know, because you want to know if there's an issue, right? You don't want to buy a house with any open violation or open permit, right? You want to make sure that it's all clear.
So if I may, Pete, we got a bunch of questions.
All right,
here.
so let me stop for a minute. Let me answer some questions.
So one
Read
question
it
from Sarvar Khan. He's asking,
Sarwar Khan, hello, Sarwar.
what do you think interest rates going down?
Do I think interest rates are going down? Yes, I do. When? I don't know. So the answer is yes, I do. But when? I don't know. I think sometime this year we're going to see interest rates go down. But of course, listen, as I said before, I mean, I saw an FHA the other day. I could do in the fours.
Yeah.
I mean, I had it down at 4.875.
And end of the day, the rate doesn't matter. The monthly payment does. So let's always focus
Thank
on
you,
the
John.
monthly payment.
Thank you, John.
Another one. Do you have Sonny Mae programs still on? I know you used to do them left and right a couple of years ago.
Right. I don't have my new company that I'm with. Name of the company, Go Rascal. We do not do Sonny Mae. However, we do have. What the big benefit of the Sonny Mae is the down payment assistance, right? What we call the DPA, and I do have a product, a lender that does the DPA, down payment assistance, and has a very competitive low interest rate, if not lower than the Sonny Mae loan.
So then it was a question: can you buy unlimited points? No.
Can you? Correct. The answer, John just said it. No, you can't. You can't go unlimited.
How much closing cost these days now? So
how much closing cost? What?
How much is the closing cost these days? And that's that's what we're going over, right?
Yes, that's right. And it's it's. I always tell people. You say so. I hear this all the time. What are the interest rates? What are the interest rates? What's the interest rate?
What's your rate, D?
What's your rate? What's your rate?
Shopping around.
What's the closing cost? Tell me the closing cost. I sort of sometimes I'll come back to someone and I'll say, well, hey, how much is a car? Tell me how much is a car. Can't say that, right? Is it a used car? Is it a new car? Is it a Lamborghini? Is it a Honda Civic? I have a Honda Civic, but it depends. It depends on the car,
Yeah.
right? It depends on the year. It depends on the
different factors.
Different factors, So a lot of different factors. So closing costs. I mean, you're going to see. I mean, I'm gonna take you through a loan that's an $850,000 loan, and actually, here's a closing cost. Let me go right to the heart of the matter here. There's a 2-point buy down, right? 2-point origination fee, and the closing costs on this loan are $39,000. $39,000. Now that includes the mortgage tax at $13,000 because this is a New York City property. It's New York City, so the mortgage tax alone is $13,000.
Now, if it will be in Long Island,
If it was Long Island, the mortgage tax would be less, but the escrows would be more. Okay, because of the taxes. See, this is something you have to take into consideration.
but the escrow is better than the closing cost because it's like money in your pocket, which you're gonna use down the line.
So this is a great point. So what John's saying is, so let's go. All right. So we spoke about the title fees, right? Mortgage tax. I spoke about the mortgage tax, about 1.8 in New York City, about 1.8% of the 1.8% of the loan amount. Now let's go to the escrows and prepaids. Escrows and prepaids. As we spoke before, what's a prepaid? A prepaid is what you're prepaying before the closing. That is your appraisal, right? And that is your homeowner's insurance, okay? So that's a prepay. Escrows, what's an escrow? An escrow, I like to tell people that escrows are similar to the concept of a security deposit when you're renting an apartment. So when you rent an apartment, the landlord gets what? 1 month, sometimes 2 months of security, right? What's the reason for that? Well, if you don't you leave the apartment in bad shape. They want to have some money, or you didn't pay your rent. You leave the apartment early and you don't pay your rent. He wants to keep your security, but that security money is your money. It's your money, right? If you leave the apartment, if you leave at the end of the lease term, you leave the apartment nice and clean, you paid your rent till the end, you're going to get that money back. Same thing for escrows. Why the bank holds escrows is because they're holding for property tax and homeowners insurance, okay? Property tax and homeowners insurance. Why those two? Because the bank is responsible if they're collecting the full mortgage payment, right? Sometimes, by the way, you the borrower, can opt to pay your homeowner's insurance and your property tax out of your own pocket. Then you're not escrowing,
That's
right?
If you put more than 20% down the house.
I don't. Is that true?
If you have bad credit, I don't think they'll let you do that.
If you have a bad grade now.
If you have good
okay.
credit, if you could show that they
But I don't think there's a
responsible
percentage
I
down.
don't know about the percentage down.
No, I don't think
know
there's
how-
a percentage
I think
down.
your credit worthiness.
Isn't that
taken into
interesting?
Consideration.
Okay.
Isn't that interesting? So we're just talking about whether you have to escrow or not. Sometimes in certain situations, you have to escrow because, as Carl points out, you might not have good enough credit to allow the bank to trust you, sort of, to pay your homeowner's insurance and your property tax in a timely fashion.
So it's
because-
like prepaying the insurance and the taxes.
It's prepaying.
Yeah.
Well, see, so for New York City, it's every quarter, right?
I see.
For Long Island, it's every 6 months, right? So the bank is holding that money for you. They're holding that money for you to pay it to the tax authority, and then to pay it to the insurance, right? The homeowner's insurance company, right? So, see, if you were responsible to pay it on your own and you didn't, the bank's on the hook.
Oh yeah, big time.
Right? They go after the bank and say, "Hey, you're an owner with this house with the borrower. You better pay me for the homeowner's insurance, or we're not going to give you coverage.
And,
Or you got to pay."
And not only that, if you don't pay your taxes, they'll put a tax lien on it, and that always will precede any type of lien.
So I don't know if you guys just heard that.
Yeah.
John just said, excellent point. If you don't pay your property taxes, then the tax authority could put a tax lien on your house, puts a tax lien on your house, and now you're stuck. The bank and you are stuck.
Yeah.
So that's why the bank is escrowing. They're saying, look, we want to hold, like a security deposit, right? We want to hold this money for you. It's yours. We're going to give it back. If everything goes smoothly at the end of the loan, we're going to give it back to you, right? But we're going to hold it as a cushion. But nevertheless, it's a closing cost, right? So it's a closing cost. You got to come out of pocket, but you're supposed to, hopefully you get it back if you make all your payments in a timely fashion. Now, that escrow, typically it happens over time where they're going to ask you more money to put into escrow because taxes go up, homeowners insurance goes up, right? So they say, oh, we did an adjustment. We looked at it this year, and you owe us a little more to make that cushion good enough, right? So in New York City, it's typically they're going to ask for 4 months of homeowners insurance and 2 months of property tax. In Long Island, I believe it's 6 months of property tax. So your escrows are even more in Long Island. We got questions. Go.
Yeah, P. So Monica has a question. So 2 to 4% closing costs are standard, right?
How many?
2 to 4%.
I don't know. No, I don't agree with
4 to 6 in
that.
New York. 4 to 6% in New York.
4 to 6, yeah. Yeah.
4 to 6, I would go with 4 to 6. Be a safer,
Yeah.
safer
Go
bet
go
if
with
you're gonna tell
5 or
if
go
you're gonna
with
tell a
6.
client.
Yep.
Connecticut's more around 3, 3.5. Jersey's also around 3 to 4. It all has to do with the taxes.
It's the taxes, right? Good.
And this
and points as well, right? Yeah,
How many points you?
right,
Yeah.
right.
This is really interesting question. Why double change or double charge for appraisal fee from different lenders?
I don't understand.
If
that.
you can, Sarvar, clarify the
So
question
I'm not clear about
a
that.
little-
Why
little
double
more.
charge? No, you should not. You
from
should
different
not.
lenders, though. You're saying from different lenders. So, is it if you do an appraisal from one bank and then you have to do an appraisal from another bank?
Well,
that's-
so Carl, FHA appraisals you can transfer.
Transfer them over.
So FHA appraisals you can transfer from one lender to another. Conventional sometimes.
Depends on the management company.
It depends on the management company. It depends on if the appraiser is on the panel of that AMC, appraisal management company. And also, what companies are supposed to do, like if somebody leaves, if you go from one company to another, or one lender to another, you should be able to get an appraisal transfer letter, right? I have transferred in my career. I have transferred I couldn't get a loan done, and someone went to another bank, and I had transfer the appraisal to another company. Some people don't want to do it.
I'm wondering why.
Some people don't want to do it, but you can get in a lot of trouble for holding hostage somebody's appraisal.
Serve the client first before making the sale.
Don't do it. It's not nice. Not nice. You wouldn't want it done to you. Don't do it to others. Did you go through all the questions?
Yeah, there's a couple more.
So then Sarvar had a question on the closing cost over here. Let me see. All right, this is a good one, I think.
So, I love that you're here, brother.
What is the time limit, mortgage commitment, title, contract, and credit for? So I guess, for how long they good for, right? Each item.
So credit, Carl, correctly. On FH, it's
Time limit for
90
mortgage
to 120
commitment.
days, depending
So-
on the program.
say it again.
I think 90 to 120 days.
90
depending on the
right,
program.
depends on the program, right? I think it's 90 to 120 days for credit.
So 3 to 4 months on a credit.
3 to 4 months on the credit.
If it expires, you have to rerun it.
If you you just have to rerun
Okay.
it. Title, it's good. So where are you getting are you doing mortgages these days? Where are you getting all this? Are you sitting with your mortgage guy?
I know. I think he's talking about his deals right now.
So here's the thing on commitment. Carl, how long is a commitment good for typically?
Depends on your company. Oh, how long is it good for?
Like when they issue a commitment. Man,
That's
here's
a
the
good
thing.
question.
You know what? To be honest, I'm not even sure how. I think it's like 30 to 60 days, but I've never had an issue even with a commitment
It really goes
expiring.
quick.
It just, I mean, I don't know.
And I don't think it's even the commitment so much. I think it might be the rate when you lock in the rate too, right? Because that's probably more important than the commitment letter itself.
Right. I mean,
You
I've
can
never
extend that,
had. I've had commitments expire because things have went too long, but like to get it updated, just to get it
Extend
refreshed.
and
But
stuff.
it's a good question. I apologize. I don't know the answer to that. And then title, I'm not sure about that.
Well,
either.
title it's forever, right?
No.
So,
Title,
I mean, the
title.
title insurance, not the search.
Right, but you have to update. You have to update the title like a Schedule A. Its effective date it can expire, and you have to re-up the title.
Check again.
Yeah.
Search probably.
I'm going to get back to you on those questions. So there's a good question
By the way,
with regard to the contract. Go ahead.
Fannie, Freddie, 120 days on a credit report, 90 days FHA.
90 days FHA on credit. Thank you, Carl. I thought that's what it was. Fannie, Freddie, 120 days. With regard to the contract. So typically, what do we see, John? We see about 45. I've seen 45 days to get a commitment, which
Yep.
I think is
Yep.
crazy
Yeah.
too long.
Yeah.
You should be closed in 45 days. I mean, I'm getting closings done in 30 days, to be honest.
And I mean,
So,
that's in New York, right? If you're talking about REO, it's threshold 30 days.
yeah,
I mean, if you go out of state, it's like 2 weeks.
gotcha. Okay,
Right.
okay. So but contracts in good point. Contracts in New York City typically they give us, as where 60 days. 60 days to close, 45 days typically for commitment, which I think is way too long. Next question.
By the way, 30 days commitment. Our commitments are good for 30 days, but lenders could allow it to go more or
Carl's just telling me commitments are good for 30 days, but lenders do allow it to go longer. I've never had an issue on an expired commitment just being re-upped or updated. What else? What else
Sweet.
we got?
Another question: can buyers get a lender's credit if sure amount during the event?
Can buyers get a lender's credit? Absolutely. Buyers can get a lender's credit. Buyers can get a seller's credit.
Sales concession.
Seller's concession. Very
Now, what is
wonderful.
the difference between those two, and is there a limit, and how does that work exactly?
so.
Depends
Look at these questions.
on-
Woo! Questions.
Like
Holy
10 classes on
smoke.
one, huh?
Woo!
Stretching, please. Stretching.
Woo! Carl, could you look that up for me? Because I don't know. It's so on 6% on a seller's concession.
It depends on the down payment.
Depends on the down
It
payment. I
depends
knew
on
that.
the LTV.
20%.
So it's a loaded question.
Right. So 20%, you can get a 6% seller's concession. I don't know the other.
Oh,
We're gonna
you
get
got a
back to you
20
on that.
20% down payment.
20% down
Okay.
get you up to 6% up to 6%
Okay.
seller's
So the
concession.
20% minimum, and I can get up to 6%.
Correct. And I think you could go. I'm pretty sure you can go as high as 9 and as low as 3. So I believe it's 369.
Of the purchase price.
Right, of the
purchase price and loan amount.
purchase price. Yeah, it's a 369, Carl, and it's dependent upon the down payment.
Yeah.
We're gonna get you that information right now. Carl, thank God, is looking it up for me right now.
FHA 6%.
FHA 6%, regardless of the down payment. Now let's explain while you're looking that up. Some people don't know what's a seller's concession, what's a seller's credit, right? It's a wonderful thing, I'll tell you that. So here's an example where
It's some money though, which seller's giving you for free. No, it's not that.
it is not money, as John just said. So it's a credit that the seller is giving, or concession, conceding. What's the definition of concession? I concede something. I give you something. What am I giving you? I'm giving you a credit. A credit towards what? Towards your closing costs. Can you take that money and pocket it? No. It's a concession, a credit towards your closing costs. Why is it effective? Why is it wonderful? Because it allows you to roll the closing costs into the loan. Big deal, right? Because you can only roll closing costs into a loan when you're doing a refinance, not a purchase. But if you get a seller's concession, that's the way you can roll the concession or the credit into the loan. Now, how does it work? How does it happen? Why would a seller give that to you? Not every seller is going to do it. Why would a seller do it? A seller will do it because they want to help you, entice you. Maybe they're not moving their product. Maybe they're not moving their property. Maybe they want to, they like you. They want you to buy their property, but you didn't have enough money for the down payment and the closing costs. So they say like this, it goes like this. Tell you what I'm going to do. I want $500,000 for my property, but I'm going to give you a 6% concession. That's $30,000. That should cover your closing costs. Okay. Now in this case, it's $40,000, but it's an $850,000 purchase. Okay. $500,000 purchase. I want my $500,000. I'm going to give you $30,000 to help you with the closing costs. I'm not giving it to you for free. You can roll it into the loan. I'm going to charge you for my home on the contract $530,000. $530, right? So it's $530. So now you got to put down payment based on $530. So if you're putting 5% down, or 3% down, or 10% down, it's based on $530. And your loan amount is based on the $530, right? But you're rolling closing costs into the loan. I've had people buy homes for like 3% down, or 5% down, some low down payment, and roll the closing costs into the loan, and they get a home. It's pretty cool. Right.
They have to get approved, right?
Yeah.
Right.
What their max is 800.
So Josh points out, excellent point, is you have to qualify, of course, for that. Number one. Number two, you might say to me, well, Pete, why wouldn't sellers want to do that all the time? Sellers don't want to do that, or may be hesitant to do that, because the house has to appraise for the higher amount, right? So he wants the 500,000, he or she, but the house has to appraise for 530, right? So there's the 6% on top of the 500,000. So the house has to appraise. If the house appraises, everything's golden. It doesn't hurt the seller. The seller still gets what they want. They get to help out the buyer, and everybody's happy. Carl, you have information.
So you ready for the seller's concessions? Conventional loans, putting less than 10%, 3%.
Okay. Conventional loan, you're putting down less than 10%. Seller's concession is 3%. 3%.
You put in 10 to 25%, it's 6.
10 to 25 is 6. Wow, 10 to
10 to 25 is 6.
10 to 25 is 6.
25 more, 9.
Conventional. 25% or more down, you can get up to 9% concession.
And
Wow.
investment properties are capped at 2.
Investment properties. Wow, that's cool though. You can
No
get a
matter-
seller's
no matter your down
concession.
payment.
You can get a seller's
Doesn't
concession
matter
on an
down
investment
payment. Wow.
property, 2%.
I mean, the sweet
I don't
thing
claim
is-
to know everything, but that's why, we got Carl and we
Oh.
got John and Josh here.
And I mean, Pete, we're doing a lot of deals where we get the sales concession for the buyer, and even if they have the closing costs, and let's say the home needs some attention, maybe some repair,
Yeah.
right? They can save up the money for the repair, and they can get a concession to pay for the closing costs.
Listen, in my opinion, everybody's different. But if you can roll the closing costs into the loan and keep the money in your pocket for whatever, for repairs, just because you want to keep cash on hand, do it. Because here's the thing you got to remember. When you take 10, 20, 30, $50,000 and you stretch it over a 30-year period, I could show it to you on my calculator, or you could look it up on a mortgage calculator. It's a really small change in the mortgage payment. So if you can save that 10, 20, 30, 40, 50,000, keep it in your pocket and roll it into the loan, take advantage of doing that. And by the way, whatever you buy today, if we're in the 6 or 7% interest rates, okay, it's going down. So you'll refinance within a year or two, and you'll get a better interest rate, and that'll be it. So hopefully, but the most important thing is you go find a good deal, right? You go find a good deal that's a payment that you could afford right now. That's important. Okay, John, questions? Could you?
Yeah, seller's credit. Now, what is the difference between seller's concession and seller's credit, right, for repairs, let's say?
Now,
And
I
can
don't
you
think
get
there
and can
is
you
a-
and can you
there-
get?
It's the same
No
thing.
difference.
It's the same thing. You
It's
can
just a
adjust-
different
There-
word.
on the CD or the closing disclosure, you're going to see seller credit, even if it's a concession. There's
Yeah, it's the
nothing-
same-
No line item that says concession.
I see.
Same
Okay.
thing.
Carl, I'm very happy that you're here.
Carlo, the facts and data. Carlo Pinheiro.
Yes, sir.
So you said up to 6%. So on this example, 6% would be 51,000.
Yeah,
So your closing cost is
So
only
here's-
39.
it's a good point.
Can you pull that money out?
No, you can't
Can you
use
take
no.
that extra 10?
No, you cannot. You cannot. That's a great question. So you want to get right. You want to get, because it goes back to it actually goes back to the seller, right? So you can't pull cash out.
Okay.
You can't use that cash for something else.
Now, Monica has a question. Can you repeat that again?
Right. So
Up to 9%?
So 9% seller's concession can be given up to 9% if the borrower is putting down 25% or more. Right. So it's a percentage, right? We went from 0 to 10, gets you 3% concession max. From 10, it can't be 0 to 10, it can't be 10. It's got to be more than 10.
Yes, 0. Yeah,
0 to-
less than 10, 3.
Oh, less than 10.
Yep.
So up to 9.99
Mhm.
down payment, 3% concession, 10% to 24.99.
No, 225.
Oh,
plus the 6.
Oh, excuse me, my bad. Thank you, Carl. 10 to 25, you can get 6% concession, and then over 25, you can get 9% concession. Right.
If
But
you
you-
25.0001, you're getting 3% extra.
Correct.
Which, I mean, but that's only Monica.
But that's a
for
really big
primary
seller's
residence.
concession.
That's for primary.
That is correct. For
residence,
investment, as Carl pointed out, 2% max seller's concession, which I'm surprised you can even get a seller's
and
concession.
it doesn't matter on the down payment. So if
It
you
does not
put
matter.
5%
Investment
down,
property. Now I learned something new. Thank you, Carl.
that's great.
Beautiful.
We all learning here, guys, which is great. Good question. And look, we got invitation for dinner from Sarwar. I love that.
So War, I would love that.
Oh yeah.
We are way overdue, my brother.
Yes.
Way
yes,
overdue.
Yes.
Thank you.
Beautiful.
It's funny. I was thinking about you actually just a couple of days ago. So I'm thrilled you're here. And
So I mean that's great. Do you guys have any questions on the closing costs or the CD?
so let me just right. So this was the closing cost. This was the prepaids and escrows. One thing I did not mention. Okay, I spoke to you about the escrows. I spoke to you about the appraisal, the upfront payments. Then there's the interest. Okay, and that's also considered. That's in here. I'm not sure why it's in here, to be honest, because it's not. You're not prepaying it, but it's prepaid and escrow. So the interest, the per diem interest. This is really interesting. When you close on a loan, from the day that you close to the end of the month, you're paying interest per day. Okay. So for instance, if you close on the 20th and if you close on the 20th and there's 31 days in the month, there's 11 days of interest that you're paying, right? So per day, per diem interest. Now, when you close, let's say you close in January, you don't have to make a mortgage payment until you skip a month. So you skip February and your first mortgage payment is due in March. Okay. So that's kind of cool, right? Because you're skipping a month.
It's probably because it's postpaid, the mortgage. It's like
Yeah.
you pay like rent.
Right. It's not to be right.
Reverse, yeah.
That's right. So some people say to me, they say, well, if I'm skipping a month, let's see, if I close at the very beginning of the month, if I close at the very beginning of the month, I almost have to not make mortgage payments for 2 months. Sort of, not really, no. But remember, if you close at the beginning of the month, you're paying interest for all of those days. So let's say you close on the 3rd of the month. There's 27 days to the end of the month. It's 27 days of interest that you're paying. But yes, it feels like, I know, it feels like you're skipping almost 2 months before you have to make your next payment. Okay. So when you add all this stuff up, right, this top portion comes out to 34,500. This comes out to about 5,000. Here you can see on this side, I add these two up over here, and that's a total of 39,000.
By the way, with the escrow, when you then selling the house, the escrow is going to be released to you. Not at the closing, they'll send you a check, which is, many times it's a nice bonus, right? Because if the taxes are $6,000, the insurance is $2,000, it's like $8,000.
Great.
Which you're gonna get extra. Which most people, quite frankly, they don't really think about the escrow.
So just to repeat what John said, I'm not sure if you guys are hearing that, but what John's saying is when you close and let's say you haven't finished your mortgage and there's escrow money that's due you, right? Because you've been paying your payments on time, you're going to get a check back, right? Just like I said before, if you stop your insurance early, you get a prorated portion back. Well, it's the same thing sort of with the escrows, right? You're going to get that escrow money. You should be getting that escrow, whatever's in that escrow account, back to you. So, right, that's a good thing. Okay, so 39,000 is the approximate closing costs on this with 170,000 down. The total investment here is about 209,000. About 209,000. Okay. Next.
So again, guys, if you find us helpful, give us some thumbs up, give us some likes, share it, comment. And if you want the calculator, the mortgage calculator with the closing cost calculator.
Yeah, anything. Well, here's the thing with
anything and everything.
Anything you guys want, I'm happy to send. But let me just say this.
Are you sure anything?
I know I shouldn't really share it with everybody.
Anything. I don't know anything.
Could be mortgage bankers out there.
That could also, you have to be careful because you don't want to get the wrong advice. There's so many things inside those calculations that require special technique to figure out.
So that's true.
You have to be very careful.
So thank you, Carl. So So a lot, these calculators, I'm entering information into them, right? I'm figuring stuff out, like the title for the title fees. It doesn't populate. That's not like automatic. I'm filling a lot of this stuff that I do is manual. So it's a combination of manual and calculated. So to give somebody and say, here, you just plug a few, like my first spreadsheet, I don't really mind giving that because that's,
Easy,
the dark, it's easy.
Straightforward.
Right. If you have a question, you call me. But the closing cost one, there's manual stuff
It's
involved,
more
and
involving, and even guys, quite frankly, and let me know what you guys think, if it will be something you guys are interested in. If you guys want me to come back and maybe actually do the breakdown, right? Actually walk them through on how you calculate the closing costs on, let's say, a specific property, a specific deal.
right. I mean,
Then we can go into it like, okay, this is where I find the PMI, this is where I find the title, this is how I calculate those items.
Yeah.
And it's all recorded, and they can sort of, do it with you.
okay,
That I think would be a great idea. So if you
Okay.
guys like it, just let us know. So we
okay.
can make sure we bring P back. It's hard to bring this guy back
No, it's not.
because he's
I'm
he's
just a phone
busy.
call
He's
away.
he's busy.
I'm
but
busy, but not
no,
too
when
busy,
we
not too
bring him
busy
back,
not too
we
busy for
try
John
to
Tayeb.
extract as much value you can get out of him. So thank you, Brandon. Appreciate it.
My pleasure. My pleasure.
So we got another question. All right. So great job. Okay, Diana, but she likes it. She likes it. Good job.
Thank you.
Thank you.
Thank you,
Appreciate
Danelba.
that.
Keep on going.
All right. Well, should we go into the buy down calculator? Do we?
Another session.
It's another topic.
I think with the buy down, I think we'll bring P back.
We'll do it. Yeah. This
Yeah.
is this. Just a real quick on this.
Yeah.
This is a calculator.
This is just a teaser,
This
right?
is
This is
I'm giving you
something.
this is a tease.
This
I'm
is
giving
something
you
to
a
get
tease.
you excited, so you have to come back next time, okay? We're not gonna give you everything because that's gonna be overwhelming, and we don't want to do that, right? So,
All right, so this is so what has become popular these days is the temporary buy down, right? What is that? Temporarily buying down the interest rate, right? Temporarily buying down the interest rate. Now, here's where a seller can give a really cool, or you, the listing agent, right, can give a really cool thing back to the buyer and entice them. It's about enticing, right? Bringing more buyers to your open house. How do you do it? Advertise a temporary buy down. Hey, buyer, I know the rates are close to 6, 7 today, but how about you pay for your first year 3% less than the prevailing rate in the first year, 2% less than the prevailing or current rate in the second year, 1% less in the third year. How would you like that? On the seller. The seller is offering that. My seller is offering you this temporary buy down. What? How did that work? Come talk to my mortgage guy, come to my open house, and we'll show you how that works. And what it is basically is very cool. The seller is basically giving a credit, right? We spoke about that seller's credit. The seller's giving a credit to buy down the rate for the first 1 or 2 or 3 years of the mortgage. Now, why 1, 2, or 3 years? Because we in the mortgage business and many of the experts believe that rates are going to come down, right? Inflation driving rates up, and the war in Ukraine driving rates up, all these things in the economy driving rates up. Feds, we got to get inflation under control. Anyway, rates will come down perhaps in the next year or two. I believe this year. A lot of my friends and coworkers think this year. When they come down, you get out of your temporary, your current loan, and you refinance into the new loan, 30-year fixed with a hopefully 4 or 5% interest rate, right? I'm in them in the 4s right now on an FHA product. So anyway,
that's pretty incredible, right? And I think the buy down, it actually helps many people to get into the house now. And possibly when it comes down refinance,
this is crazy hot right now.
Yeah.
And a lot of realtors don't know about it. A lot of buyers don't know about it. But you, the realtor, can sell this, right? You can pitch this. You can pitch this on your listing, or you pitch it in your advertising. Hey, my seller's giving a temporary buy down. And a lot of buyers would be like, what's that? What's that? But let them ask the question, right? What is it? Oh, buy down the rate. Oh yeah, I get a lower 3%. I can get a 3% rate right now in the first year, 3.5 in the first year. Let's do it. So this is a calculator. I created it. It's awesome. I think it gives you the 3-2-1, the 2-1, the 1-1, the 1-0, and it shows you the breakdown. I mean, here real quickly, right? Year one, right? It takes the 7.625%, and year one minus 3, 4.625, year two, 5.625, year three, 6.625, year four plus 7.625. But again, you should be out of this loan within a couple of years, within a year or two, right? You're going to refinance. Anyway, I'll go through this calculator in the next session, show you more. Hope you like it. Thanks for staying with us. Yeah.
We appreciate you guys. Again, if you like this, let us know. P, we really appreciate it, man.
My pleasure,
Me personally, I got so much value out of
thank
it.
you, brother.
And I mean, doing this for almost 20 years and always learn something from you. It's a pleasure.
Thank you.
Next week, we won't be in. I'll be in Dallas. So we'll be on the following week in 2 weeks. If you guys find this helpful, don't forget to like, subscribe, and share. And P, let's go eat.
Thank you.
Peace out.
See you guys. Thank you.
Bye.